everyone, it's Marissa here from Rise High, and today I'm joined by Amanda Watchman, who's the Managing Director and Senior Accountant at Rick Watchman and Associates. And today we're talking about ownership structures, which may not seem like an exciting topic, but it's so super important whenever you're buying a property or buying a significant asset. It's really important to get your ownership structure right. And at Rise High, we always love to educate and empower through education. So these sort of sessions are just to empower you with more information. So I'm super glad that Amanda's here today to help me with this topic. She's a wealth of knowledge, and obviously, you know, it's really important that you get advice from a great accountant or lawyer when you are thinking about ownership structures. So today what we're hoping to do is go through the different ownership structures that are possible and look at the pros and cons, and also talk about in which circumstances or scenarios would you consider certain ownership structures. I guess the important thing to point out is there really is no one size fits all, and there's pros and cons to every ownership structure. So it's really important that you get the right advice that's right for you and your situation. And that will be different for everybody, and every time you buy a property it might even be different. So how are you, Amanda?
I'm well, thank you. How are you?
Yeah, good, thanks. Thanks for joining us today.
No, it's been a busy year.
Has been. Yeah, it's been a very interesting year, hasn't it? Well, let's get into it. And I think, firstly, let's just start by talking about what are the popular ownership structures that people do use to buy property in.
Generally, the most popular for property owners is in the individuals or as family trust structures. They give you the ability to be able to kind of manipulate and distribute profits to your family members, and it gives you a little bit more of an ability to minimise tax, which is a great incentive for our property owners. So,
so you can buy properties as an individual, and that could be an individual, just me, myself,
yes.
Or it could be husband and wife. Like you said, there's trusts.
Yes.
There's also companies. Do you find that people use companies as well as an ownership structure?
As in not for investment properties. Companies are used more so for businesses and for running enterprises. So that's the main reason why we use that.
Okay.
You could also look down the road if you individuals that are not related. You can do partnerships of trust, which gives you a little bit more of a flexibility if you're not within the same family.
I find that companies are not really a popular option for owning property, except when maybe it's a development project
If you're a
or something like that, then they might consider companies. But given that companies are not a popular structure, I think today let's focus on individuals and trusts, because there's a lot to delve into just with those.
Yeah.
So let's talk about individuals, and in the case of an individual, let's consider the option of just an individual in their own right. What are the pros and cons of someone owning a property, like buying an investment property in their own name and doing it that way? What are the pros and cons of doing that?
Yeah, so as an individual, it's a lot easier to obviously identify and report with the ATO in regards to your property investment. So you would obviously buy your property, and we'll just for this example, we'll just do one individual, not husband and wife situation, but they would be able to kind of report borrowing money through their own finances, so it's a lot easier for finance purposes. And they'll be able to report on the income and expenses that they've incurred in the property in their tax return when they lodge it with the ATO. And it's a lot simplified way of doing the tax returns and declaring your income with the ATO.
So if they buy a property that's making a loss, so it's negatively geared property, which probably most properties are when you initially buy them, that negative loss, I guess, does that just get offset against their income?
Exactly.
So then they'll get a bit of a tax refund?
Yes, tax benefit, definitely. So generally individuals would negative gear because of the interest that they pay on their loans, and depreciation schedules. So BMT doesn't do depreciation schedules, and it maximises the deductions for the property, and then that obviously reduces the income, or actually makes a loss situation where individuals can then provide the PAYG or other sources of income that they declare in their tax return, and that's offset against the rental loss, which is a great incentive, and also gives them bonus refunds, which is always a lovely thing, getting money from the ATO.
So I guess one of the good things about setting it up Well, there's a couple of good things that you just mentioned about setting it up in your own individual name. Firstly, it's a bit simpler,
Yeah.
probably cheaper because you don't have to set up new structures.
Yeah.
You have the ability to offset negative gearing losses against your income, so hence you might be eligible for a tax refund. There are some downsides though.
Yeah.
So let's talk about asset protection
Yeah.
as one option, and then let's move on to capital gains tax. So I'm keen to hear your thoughts on both. So let's talk about asset protection as a starting point. What are some of the reasons why you might steer away from owning a property in your own name?
Yeah. Generally, I mean, as a rule of thumb for myself and my clients, if you're in a business and you're running your own business and you're a business owner or a director, I wouldn't suggest putting it an asset or an investment in your own name, just because there's more risks associated with you being a director of a company, and you may lose, intentionally or unintentionally, things happen and without your control, and you may get into a situation where you're either bankrupt or liquidated or getting sued, and your assets are at risk and you lose them. So as far as the minimisation of that type of risk, it's definitely a better idea.
And that probably also applies to, high risk industries like doctors, lawyers, people that, like high risk industries that do have the potential of those sorts of things happening, unfortunately. So in those situations, you may have to think twice about buying a property in your own name. I guess the other thing that's really important is I find that so many people, when they're thinking about ownership structures, think too short term. I feel like they really need to think long term to know sort of what their plan is for this property. Is it a property they're going to hold forever and pass on to their children? Is it a property that they plan to hold for 10 years and then sell? Or is it a property they plan to hold and then develop and then, keep renting? Or what do they want to do with it? And from your perspective, from a capital gains tax or a long-term perspective, what are some of the downsides of owning property in your own name?
Well, I guess for individual property owners, your income is combined. So when you go to sell a property, you'll have a capital gains tax, and that forms part of your assessable income overall. So if you're having a really good year and say you're a doctor and you're making a lot of money, that additional capital gains is added to your tax, and your tax rate will increase. So there's no real incentive, I guess, to buy a property and then sell it in the short term, because you're going to be paying higher tax. So it definitely is a good idea why looking at why you're buying property, what's the purpose of it, how long you're looking to keep the property, so you can actually make those good choices and decision making to minimise the actual capital gains and any risk factors.
Yeah, I definitely suggest that if you're looking to determine the right ownership structure, you try and have a bit of a plan for what you might do about the property. And it's also super important at this point to point out that you should be determining your ownership structure before you sign a purchase contract, ideally.
Please do, yeah.
So, often once you've bought the property, it's almost a bit too late, because to change ownership structures is so expensive. Firstly, you need to go through the loan process again, but secondly, you've got to pay stamp duty, potentially some capital gains tax. So super important to get that done up front.
Yeah, and I guess if you do find a property from your dreams, or you rent a property and it's a great investment, you don't want to lose out, you can advise obviously the real estate agent and conveyancer and or nominees. So it provides that kind of added buffer to say, okay, it could be myself or someone else, which would be so you can always protect yourself that way, I guess, if it is, that spontaneous kind of purchase.
Just to sort of reiterate what you just said, because I think that's a super important point. So Amanda just said if you don't have your ownership structure determined at the time that you sign the contract, where it says purchaser's name, sign Joe Smith and your nominees, so that that actually gives you the ability to have some time to think about it and get the right advice, and then you can provide a letter of nomination which says who the purchaser will be. So that's a really, really good point. If we sort of move on to still individual ownership, but individual now in a couple. So husband and wife as a scenario, or de facto couple, or something like that. There is a couple of different ways that you can own property with someone else. So one way is joint tenants, one way is tenants in common. Can we just break both of those down to help to understand what they mean and what the implications of those structures are, because I feel like that's really important to understand as well.
Yeah, so I guess with the joint tenants, that's a fairly common type of ownership, and it basically allows you to have one or two or more individuals owning the property, and it's generally split by the number of people in that joint.
So they have an equal ownership.
Equal ownership, yeah, correct. And I guess with the tenants in common, it's the ability to be able to kind of say, okay, well, we might not want 50-50 ownership, we might want 30-70 ownership, or whatever is going to be in the best interest of the parties at play that are buying the investment property.
And what are some of the considerations that would come into play with determining the percentage of ownership, for example? So let's say you had a husband and wife scenario and they actually didn't want to own the property 50-50. In what sort of scenarios would you find that it would be advantageous not to own the property equally and to have a certain percentage allocated to one party versus the other party?
Yeah, so I've recently just gone through this with a new client that the wife is actually the breadwinner and she's making quite a bit of money and he's making a small amount of money, but obviously still needs to be on the title to be able to kind of have more own protection purposes. So we've decided 10% will go to him and 90% will go to her, and that will allow her, because she'll be negative here in the main property, she's going to get the tax benefits that he would otherwise not receive if his income is lower.
So that decision was made makes good tax sense. Yes. It still means that they both are on the title.
Yes. Ownership's still there.
Yeah. Now there is an added thing with when you do own the property as joint tenants, like the example that you just gave. You do have to make sure that you are documenting what you want to happen with your share in your will for estate planning, because with the other scenario where it's joint tenants, which is the most common scenario for a husband and a wife where they own their marital home or the home they live in, if one person dies, the other person automatically gets their share. That's not the case in the case of joint tenants. Oh, sorry, tenants in common, that's right.
Yeah, so tenants in common, you do have to specify with the will, and you will want to protect that because it's automatically goes to the estate. So you want to continue that ownership and have that, I guess that asset in your name as the way you've actually planned it to begin with.
I also find that tenants in common is a popular structure for when you're buying with someone other than your spouse.
Yeah.
So it could be that you're buying an investment property with your brother or with a friend, where you do need to specify the percentage of ownership, and then you do want to be able to give your percentage to someone other than the person that you own the property with jointly.
Absolutely, yeah.
A big shout out to Emily, Michelle, Todd, Julie, Tina, Nick, Geordie. Thanks so much for joining us, guys. We are available to take questions live today, so please feel free to put any questions in the comment section below. We also, as a very special offer, Amanda has kindly offered to have a free half-hour consult with anyone who mentions this video that they've seen today with any Rise High clients. So definitely take advantage of that. That's very, very good. And we are going to be leaving with you free downloadable today that you will be able to access after the segment. So definitely stay tuned. Send your questions through, and we are more than happy to answer them. Let's move on. I feel like we've covered enough about individuals. Is there anything else that we need to talk about with that?
I guess really also the other factor with individuals is, like you said, it's long term. You're buying property for long term. So when individuals buy properties and they have that huge source of income as they're working and being employed, it's at the other side of the scale where you have for 15 years that you have the capital gains issues, and obviously the capital gain tax that you may have to pay if you've had a good gain on the property. So I guess it's also important to understand, for now, yes, these are the purposes of buying the property in this structure and this percentage basis of ownership. But then moving forward, 15 years time, you'll still have to, you'll go to sell that property eventually, and you'll have to obviously declare the capital gain. So if your income, ideally you've retired by then, your income's lower, then you're going to not have a massive tax bill as opposed to still working and selling that property. So it's just good to kind of reiterate that as well.
Well, that just comes back to the point of really having a bit of a plan for the property that you purchase and having, I know plans can change, but it's good to, if you're going to buy a property, just to have some intentions of what you might, intentions and goals for that property, how long you think you might hold it for, if you do plan to sell it, when you think you might want to do that. Also, how many years left in your working life? You know, all of these things are relevant. Your, I guess your children's situation is relevant. Like, all of these considerations are so important. So that's where getting individual specific advice is so beneficial, isn't it? Yeah. So we also mentioned trusts, and trusts are a super popular way to own investment properties. I love trusts. Let's talk a little bit about trusts. The most popular one must be the discretionary trust, sometimes called the family trust. Pretty similar, aren't they? So firstly, can you just explain what a trust is? Because that might be something that not everybody knows. So let's start with that, and then we'll delve a bit deeper.
Okay, so a trust is a form of structure that we use, and the trustee is the owner and also the seen as the actual, I guess, individual or
The legal owner.
Legal person. Some people have companies as trustees for trust, or individuals. Individuals seems to be the most popular way of setting up trust. And the individual or company is the legal entity, and the trust itself is the shell which holds the assets. With a trust, you can obviously have beneficiaries that will allow profits to be distributed to, depending on the circumstances. So it's a great vehicle to use to have multiple kind of assets and benefits, and also to look to reduce tax.
Yeah. So, what are some of the, I guess, the main advantages of choosing a trust over individual ownership for an investment property?
Yeah, so with the investment property side of things, I guess the main advantage is the fact that not one individual will be assessed on the income. We'll be able to look at the beneficiaries. So the beneficiaries are automatically the, I guess, the immediate family, and then obviously distant family. So it includes uncles, aunties, grandparents, everyone that you can possibly think of. The benefit with trust is individuals obviously don't pay tax when their income is 0 to 18,000. So if you were to distribute profits from a trust to an individual that, say, is a student in university that hasn't got a good source of income, you can actually distribute that profit and pay no tax.
So this is quite a flexible structure for a property that's positively geared. So a property that's making a positive profit as opposed to a loss. It means that you've got the choice and freedom to allocate that profit however you want to whichever family member you want, which will then potentially reduce the overall tax payable. So I guess in the example of capital gains tax, so when you go to sell a property in a trust, it's not such a big hit, is it? Because instead of just one person paying the entire capital gains, you may have multiple family members over which this capital gain could be split over, which would make it a bit less of a burden.
Yeah, definitely. And it kind of allows you to kind of see where they're at, and I guess plan.
Yeah.
I mean, like you're saying, you have the goals and you plan for when you're going to sell the property. You can actually plan how to minimize the tax on capital gains.
So that's obviously a big advantage when the property is at a point where it's starting to make a profit.
Yes.
But let's talk about when the property is making a loss. Because, I mean, I guess the general life cycle of an investor is I'll buy a property, initially it will be negatively geared. At some point in the future there'll be a turning point where it goes from being negative to being positive. And that's sort of the general cycle of how it goes, depending on what property you purchase will depend on how quickly you get to that turning point. So let's just talk about what happens to a property that's in a trust that is negatively geared, so it's actually making a loss. What happens to that loss?
Yeah, so with, unfortunately with trust, any loss that's incurred, or any capital loss, it's actually, it's trapped, I guess, within the trust entity, and will have to be deferred, and can be offset against future profits. So it is trapped, but it can be absorbed at later years.
Yeah, that's such a good point, because I think initially when people consider trust, they don't go down that path because of that reason, because I think they're losing that benefit of the loss.
Yes,
because it's not offsetting the income initially, but what it's offsetting is future incomes at a point in time when they may need it more.
Yeah, absolutely.
So it's definitely, you don't lose that loss. It's just sort of sitting, it accumulates in the trust, which is really good. So in which, I mean, expensive to set up?
There
What sort of?
is obviously a cost. So generally it's around about $540 to set up a trust. That includes the trustees and setting up the ABN and tax one with the ATO. And with trust.
So that's not a huge expense.
No,
It's a one-off cost. It's a tax deductible
It is
cost.
tax deductible, yes.
Yeah.
And it is a one-off cost. I guess in a similar sense of an individual having a rental property, it's a trust having a rental property. So you still doing the same amount of, I guess, keeping records and keeping everything up to date, but you will have to lodge a tax return as well with the ATO and also distribute profits for,
So your annual accounting fees might be a little bit higher. But what other benefits are there apart from the flexibility of distributing income? Are there any other benefits? Like, does it give asset protection benefits, or what other benefits would you say there are to owning property in a trust?
Yeah, I guess I can use my personal circumstances. I'm obviously a business owner in my own right, so I have a trust that looks after my entity and my business. And so when I have a rent property with my husband, we have an investment property, our investment trust, and he's the trustee, and he takes the responsibility on. So I'm protecting my assets and our assets by having the diversification of ownership, which is a really good, unique way of protecting, your assets and your situation.
So it does provide some asset protection benefits. Are there any other pros or cons that you think are worth mentioning about a trust?
Well, the trust, obviously, you're still able to kind of distribute to your beneficiaries. I guess the only problem with the trust is minors, so anyone under the age of 18 is restricted by how much they can actually receive, and it's only $414. So that kind of is, I guess, a disincentive for some people that have younger kids. But
I guess once those kids grow up, then you do have the ability of them distributing to them as well.
Yeah, exactly. And the idea, I guess, with the property is to have it for a longer period of time.
Absolutely.
So, you could have, when they're at that perfect time of turning 18 and doing their own thing but not earning that income, you still have the ability to distribute.
Absolutely.
Yeah.
A few shout outs. Hi to Stephen, Sean, James, Marissa, Amanda. Thanks for joining us, guys. Really excited to have you on today. Please feel free to ask any questions in the comments. We'll probably be here for another 5 or 10 minutes. So if you've got any questions that you want to get answered, now is your opportunity. As I said earlier, Amanda has kindly offered to run some free half-hour sessions with anyone who mentions this video from the Rise High community, and they can sit with her for half an hour to get some advice about ownership structures, which is super cool of you, Amanda. Thank you. We've also got a free downloadable that will provide you the link to as well. We're talking about trusts at the moment, and what I'd like to do is just talk about a few examples of where people might choose a trust over individual structures. There's an example that comes to mind from a finance perspective that I want to sort of mention, and then I'd love to hear if you've got some more examples of where you think it's useful. We sometimes find that we've got a young person who wants to buy an investment property, and they may not actually have the borrowing capacity in their own right at the point in time when they come, but they can afford the loan, but they just can't get the loan in their name. And in some of those situations, we've found that a trust has been really useful, where the child is a beneficiary or the appointer of the trust. The parents who do have the borrowing capacity have gone as trustees, and they've bought the property. The child has actually been maintaining the property beyond the purchase, but at the point in time when the child has the borrowing capacity, we can just change trustees, and it means that we haven't had to pay stamp duty again. And there's been no capital gain, so it's been a really easy transition where the child can actually take over the property as trustee at a point in time when they're capable of doing that. So that's been a really good use of trust.
Yes, definitely. I guess from my what's coming to mind for myself is business owners that have companies that are running businesses and they're looking to buy warehouses or offices for their business to run, and we tend to kind of suggest the whole ability to be able to do it in a trust. So the trust is the entity that holds the property, and the business still runs using that property. And it's a very popular way of kind of making sure that rent's obviously received through the trust and claimed accordingly, but it's within the family unit.
Yeah. So I guess the main downside of the trust is that there is a little bit more cost to set up, and that you can't offset the negative gearing benefits against your income. But there are a great deal of benefits. It just really depends on your personal situation, doesn't it? And there are other trusts, like there are unit trusts and self-managed super funds. They're sometimes used but less popular, would you say?
Yeah, less popular. I mean, self-managed super funds are a very, I guess, expensive way of investing, and there's lots of regulations and compliance issues that you have to really adhere to, which can be costly. And I guess as a new person that's looking into the property industry and buying a property, yeah, I think simplifying to your personal needs and requirements is really important.
Yeah, and I guess while we're on the topic of ownership structures and talking about purchasing property and growing your portfolio, it's really important to mention succession planning, because I think not enough people think about this. You know, as soon as you get debt or as soon as you've got an asset, it's really important to think about your estate and think about planning to have a will done, and there's different considerations for succession planning depending on which ownership structure you choose, and that needs to come into consideration. So can we just touch on that from a succession planning perspective, what the considerations might be? Because sometimes people buy property for the simple reason of leaving a legacy. So then succession planning is front of mind for those people. For other people, it's not about that, so they haven't really thought it through. But we just never know what's around the corner tomorrow. So unfortunately, it's just one of those things that we have to plan for. So what are some of the considerations from a succession planning perspective that might impact your decision on one ownership structure over the other?
I guess it comes down to what your intention is, and if you are looking to buy property for the purpose of one day give it to your children, how would that be done in the most tax effective and positive way? Ownership generally seems to be individual or as a husband and wife situation. So with siblings, it's a little bit harder to kind of say, I want you to take ownership and you're going to have this portion, depending on the will's requirements and your requirements. Some people buy properties for their siblings or their daughters or sons, and it's a lot easier, I guess, in that respect to kind of say, okay, well, we'll transfer the trust in the name of us to yourself if anything was to happen, and you can specify that in the trust deed, or you can specify in your will, so you can cover yourself on that basis.
Yeah, and I guess if you do own a property in a trust, you can actually gift that property to one of the beneficiaries.
Yes,
if that's something that you wanted to do. So there are different flexible mechanisms that you can use, but so is there anything else you think we should cover off on trust? We've been pretty comprehensive, I think.
Yeah, I mean, trust is a great entity to be able to kind of buy and purchase properties in. You can have more than one property in a trust. It's not necessarily a requirement to just have one property. We do have clients that have properties and share portfolios, so you can diversify within that trust if you wanted to. So it's not just restricted by the one property either. So you do have the ability to be able to kind of have multiple properties within that one trust if you wanted to.
I guess some of the considerations that we've mentioned is income tax. We've mentioned asset protection. We've mentioned succession planning. We have to mention land tax. Because that's also one that often gets forgotten, which I feel like that has to be a consideration in the mix of the other considerations of. So can you just explain?
Multiple trusts and properties in multiple trusts and not have a land tax issue, but obviously with the new regulations that's been introduced, you are kind of it's all, I guess, segregated or.
Yeah, I mean, so basically just to bring it back, so with land tax works similar to income tax, where
it's on
the more land you own, the higher the rate.
Yes,
and it's based on each individual ownership structure.
And also on the market value of each property.
The market value of the land of each property.
Capital value.
Yeah, that's right. So basically with that, you probably need to be a little bit careful not to have too much property in one particular ownership structure.
Yeah. So with land tax, obviously individually, your main residence is exempt from land tax and is completely ignored forward. But if you have one or two properties under your own name, even if it's with your spouse or partner, you will still be assessed on that capital value forming part of your pool, I guess, as far as the land tax rate or land tax amount is concerned. With the trust structure, you can actually nominate one individual to be eligible.
I think that's only available for people that already have their trusts in place at the time, though.
Yes,
So
yes, so that's what
moving
we're
forward,
doing.
there's a trust surcharge rate, which actually doesn't work out to be too bad if you only have one property in the trust.
Yeah.
But once you start to build up more than one property, it starts to become quite expensive. So it can still work where you have multiple trusts. I guess the key is just to make sure that you've considered the land tax implication and you throw that into the mix of considerations when you're choosing the right ownership structure.
Yeah, definitely. And I guess what with obviously with property as well, there's always property development. So some people buy the property, rent it out, and then to demolish and subdivide. So it's also the purpose of the property and what it's being used for.
Absolutely.
Which is really important to.
And almost thinking about, if you have a plan like that, you actually almost need to think about what's the best ownership structure at that point, rather than thinking short term and just choosing the best one for now. So I think that's been really useful. So I guess just to summarise, it's super important that before you buy a property, whether it's your own home or an investment property, that you get some advice about ownership structures and that you've found the right ownership structure for you. If you do find a property that you want to buy and you haven't had time to get that advice, sign the contract with your name and or nominees and contact your accountant immediately to get the right advice about that. And make sure that you also talk to your mortgage broker about that too, because sometimes buying in different ownership structures can impact your opportunities on the borrowing side. So that's something that really a discussion between yourself, your accountant, your mortgage broker, to make sure that all the considerations are being met. As I said earlier, Amanda has kindly offered to basically offer a free half-hour consult with anyone who mentions this video from the Rise High community. So definitely take her up on that. We'll put her contact details below. And also, we've got a great downloadable for you. It shows you all the different ownership structures and it shows you how they rank in the different considerations, I guess you could say. So you'll be able to download that for yourself to help you out. As always, we're here to help you at Rise High, so if there's anything we can do, please reach out and we would love to help you where we can. Thanks so much and have a great day, everyone. Bye.
Yeah.